What is up, interweb? This is Mike Mills with Verity Mortgage, here to answer your mortgage questions and make mortgages simple, because that is my job. So one of the questions that comes up on a regular basis is whenever I look at somebody's credit and I tell them what their credit score is, they're always a little surprised because they're expecting it to be a little bit different than what I tell them. Well, why is that? Well, the reality of it is that when you look at credit, there's actually four different credit scores, or I should say four different credit groups that you'll see a score fit into. And I'm not talking about credit bureaus. We all know Equifax, TransUnion, and Experian have a little different model that they base your score off of and give you different scores depending on what your history's been on credit. What I'm talking about is more industry specific. So when you look at the four different types of industries that are going to generally have a credit score for you, you're going to have mortgages, which is what I do. You're going to have car loans, which is when you go buy a car and they pull your credit, that's what you get. Then you're going to have credit cards, or secured or unsecured debt. The fourth thing is what I like to call consumer credit scores. So why are these all different? Well, the reason that they're different is because it's all based on certain metrics that each industry uses to evaluate your risk. So, for example, with a car, when you go buy a car, they're going to evaluate the risk in lending you that car, and they're going to ask Experian, TransUnion, and Equifax to tell us what the risk level is. But there's a couple of factors to consider why they're asking that question. Well, first off, that asset that you're borrowing from them or that you're using money to purchase is easily attainable if you don't pay your bill. If you live somewhere and you don't pay your car note and you do that for a couple months, somebody's going to show up to your house with a tow truck and tow that thing away. So that means that asset is easily recoverable. So if you've had credit issues in the past and you haven't paid your car notes, or you haven't managed your debt very well, a lot of times you can still get a car loan, because if you don't pay it, they'll just come take it back. And not to mention the fact that the amount of money that you're borrowing sometimes isn't as significant. So the risk for the lender is very low because the money's not as much and they can easily acquire their asset back. So when you look at credit scores, typically speaking, your car credit score is going to be pretty decent compared to some of the other ones. Then you have credit cards. Credit cards are a little different. It depends on what kind of credit card you get, secured or unsecured. Typically speaking, unsecured credit cards means I have a credit limit, I'm not giving any money to pay for that, and I can use that credit whenever I want. But those limits are monitored and measured. So it might be $300, then it's $500, then it's $1,000. Once you've demonstrated the ability and willingness to repay that debt, a lot of times credit card companies will start to raise your balance. But they won't do that until you've demonstrated that behavior. So the reason for that is that they keep your limit low, then their risk is low. So if you only have a $300 credit limit because maybe your credit wasn't that great, if you show good payment history over time, they'll raise that limit. If you don't, they'll lower the limit or close the card down. So credit card companies can slowly monitor that and change your limits depending on your behavior. So typically speaking, that's probably going to be the next best credit score that you're going to see because the risk level is lower. So then you come to mortgage scores. Well, why is my mortgage score so much lower than everything else that I see? Well, the reason for that one is because the risk is much greater. When we look at the amount of money that you're borrowing to buy a house, you're going to borrow $100,000, $200,000, $500,000 from the bank to buy your house. That's a lot of money. Not to mention the fact, if you don't pay your mortgage, it's not exactly the easiest thing in the world to take your house. It takes time. Foreclosure process takes a while. Depending on the state that you're in and what the laws are about your homestead, that can take a long time. So when a lender is evaluating your credit score, or anybody issuing a mortgage loan, they're going to have greater restrictions and greater requirements on what they want to see from a good borrower that has good lending behavior. So typically, mortgage scores are going to be your lowest score that you see when you have your credit pulled. Now, that leaves fourth one, which is what we call consumer credit scores. Consumer credit scores are, everybody's heard of them, freecredit.com, Credit Karma. A lot of times Wells Fargo will will provide you, or your bank will provide you with your credit score as a service. But in all of these cases, somebody is paying for that service, whether it be you, the bank, or whoever's offering you your scores for free, somebody's paying for it. So why is that score so much more rosy? A couple of reasons. Number one is because it's just kind of an estimate. They're just kind of giving you an idea of, about where you are, about where you've been, and what you can do to improve. They're just kind of a guide. They're not doing a hard pull. They're not looking at anything specific. They're just kind of getting a general picture of your scenario and giving you a score based off of that. The second reason is a little bit more, I would call, it's not necessarily on purpose, but if you think about it from a business point of view, it just makes sense. That is, if I'm paying you for this service, and let's say that I think my credit's probably around a 620, and that's kind of what I am. I see myself as a 620 borrower. And then I pull my credit with Credit Karma and it's a 630 or a 640. Well, now I'm feeling pretty good because I'm doing a little better than I want. And then it tells me every month, hey, you just paid down a credit card balance. Good job. Your score just went up. Okay. It's reinforcing with positive information that I'm making a good decision. So if I'm operating from a business model, I want to make sure that my customers feel good about my service. So if you think you're a 620 and I tell you you're more like a 630, then you're going to feel pretty good about that and continue paying for that service. So the idea behind the consumer credit scores is, hey, we're giving you a model on what it looks like, but when you go get your credit pulled to buy a car, to get a credit card, or to get a house, those numbers are going to change. And that's why you're going to see different scores across different industries. So when you're looking to buy a house specifically, just because you ran your credit score on Credit Karma and it said you were a 650 doesn't necessarily mean you're guaranteed to qualify. So reach out to a local lender, have them look at your credit and see if it actually matches. One other note on that, I get a lot of questions from time to say, well, I don't want my credit being pulled because I don't want that score to go down. I understand where that sentiment comes from, but when it comes to mortgages specifically, that's not something you really have to worry about. Back in 2006, 7, and 8, when we had our mortgage crisis in the US, the federal government went to the credit bureaus and basically said, we want you to allow people to have their credit pulled multiple times when they're shopping for a mortgage because we want them to make a good choice based on informed information. And what that meant was, back then, if I had you pull my credit and you were the first one to do it, then if I wanted to go to another bank, they had to pull my credit too. And there was a fear that if they did that, more and more my score would drop. And in some cases, that was kind of accurate. But now that's changed. Now, within a 30-day window, if you have your credit pulled 10 times, it comes off as one credit pull. So it does not drop your score. So when you're looking out there to buy a house, talk to different lenders, find out who you're comfortable with, talk to somebody you trust, and make sure that they have the information that you need to make a good decision. So when you're out there looking at credit, understand that there's going to be different scores for different reasons. And it's not because anybody's trying to take advantage of a situation. It's just because of the way they measure it. So I appreciate your time again today, Internet. Leave any comments you have down below, forward and share this video, and we'll talk to you soon. Adios.